And so tonight, Richard and I are going to talk about how to identify red flags when investing with operators, real estate operators, and also known as general partners. So we are real estate operators here at People's Capital Group. That's what I focus on doing. And Richard is an SEC attorney with years of experience. Richard, you want to give yourself a bit of an introduction there?
Sure. Yeah. Thanks, Aaron. So my name is Rich Chen. I run my own law firm practice, Richard L. Chen PLLC. We provide a large amount of advice on compliance, as well as legal issues related to securities law. We serve a lot of financial advisory firms, and we do, corporate work for them. We even do fund formation. And some of the folks that we represent also are operators and sponsors of private real estate deals. So it's fantastic to be able to be here to provide that perspective. I also am an active real estate investor. My wife and I own a number of multifamily properties. So I guess we'll be sharing the LP perspective, and then Aaron will share the GP perspective, so you can get a good sense of sort of how things fit together, and how you can make sure that you are finding the right fit for your real estate needs.
Excellent. Thank you, Richard. Awesome. Yeah, I'm looking forward to tonight. We both have a set of questions that I will ask Richard here to start, and then Richard's going to ask me some questions as well. So we'll open up for both sides there of the table, looking into setting up a passive investment. And then, of course, on the operator side here, how I find good deals, how we make sure they're smart investments, and of course, make sure we're following all SEC regulation, which is why you want to hire a good SEC attorney to guide you in that, which is what us operators do. So, of course, a good entrepreneur hires people with more experience in that space. And that's why a SEC attorney is on top of the list for a general partner here. So excellent stuff. All right, so let me open up your questions here, Richard, and we'll get started. All right.
Yeah, that sounds great. Yeah.
Excellent.
Perfect.
Okay. All right, so I know we had a couple of ideas here. Just going to see what we okay, so a good one to start with here is, how do you find the right general partner to team up with?
Yeah, it's a great question. So let's start with the concept that we're talking about here, real estate syndication deals, right? So effectively, we look at folks who are putting together a deal, they locate a deal, they may do the operations themselves, or they may actually, sort of partner with developers or property managers to do these deals. And so that's what we're talking about when we're talking about GPs in this context. Sometimes trying to find good deals, good GPs is a challenge. And part of that is because oftentimes these deals are relying on securities law exemptions that allow them to offer their securities in private placements. So how do you go about finding a good deal if these deals are not advertised, as many of them may not be, and especially really good deals where there may not be a need to advertise. So there are a number of good places that you can start. The first, I would say, is there are a lot of good networking groups, real estate investment clubs. There are real estate forums online. And there are just a host of opportunities where real estate investors gather together in communities, right? So whether it's online or in person, and they oftentimes share information about the deals that they come across. And oftentimes, these communities have both operators and passive investors, so it creates a meaningful dialogue. So whether or not you're actually actively looking for a deal, it's a good place to start, right? And just if no other reason than just to educate yourself about what's important in looking at a deal, and we'll talk about why that's important later, right? The second place you can go is nowadays thanks to crowdfunding and other types of regulations that make deals more prevalent, there are actually platforms out there that will pre-vet deals, and there's definitely some benefit to that, because they do a lot of the due diligence for you, and they will share the opportunities that they have on their platform and connect you with the folks that provide those opportunities. So that's a good way also to find opportunities. Another good way is to talk to professionals who come in contact with real estate operators and syndicators. For instance, real estate professionals, because they are needed in order to find deals for the operators. Lenders are a good opportunity too, because oftentimes you have to get construction or other loans for these projects, or financial advisors. Sometimes financial advisors are also the source of many investments. So these are actually also good opportunities to connect and to see if they are seeing any operators that they know of. Right, the ideal is a situation where they personally know of the folks who are operating these deals and can really vouch for them. And we'll talk about why that's important in a second. But those are some of the good places to think about starting when you're thinking about trying to find a good deal. And obviously important to understand what type of deal that you might be interested in, because real estate, you can slice it and dice it in many ways in terms of finding opportunities, whether it's geographic or even the type of investment you're looking at. So, but that's a good place to start.
Mm-hmm. Well, great answer. Absolutely. There's so many resources these days, and the syndication space as well has really expanded. I remember when I started doing this in 2013, it was not really that popular a space. There was like one big coach in the space, and that was really it. And now, oh my gosh, these like multifamily conferences and stuff they have, it's, my only regret is I didn't focus more on syndication back then, but I was also learning the industry, making connections and developing a management company, and really developing the resources that it took to get to this next level of real estate syndication. So took time, but boy, the real estate is a lot cheaper too.
Oh my goodness. Yeah, it's crazy.
Yeah, absolutely. Okay, great answer. So let's go on to your next question here. So what are red flags when teaming up with a general partner?
Yeah, so let's assume that you found a good opportunity or two that you're evaluating, trying to figure out whether or not it makes a good sense for you. It's really important to do your homework, and for a variety of reasons, to make sure that it's a good fit for you. Make sure that there are not outsized risks that you might encounter in doing a deal with someone, particularly someone you don't really necessarily know. And we'll talk about sort of how you can vet these things. But there are a lot of areas where you need to think about and conduct due diligence. So by due diligence, we mean you investigate and look further into different aspects of who they are, who their businesses are. The first place I would start is make sure you understand the people who are operating the syndication deal, right? And there's a variety of ways to do that. Folks who are sometimes on the institutional side, they'll ask for a background check, or you can simply do an online search. You can ask questions in the forums like the ones that we talked about earlier in terms of finding deals, right? The idea is that you're trying to make sure that you don't come across a situation where someone has some sort of difficulties in their past that might make it more likely that they might have, it might pose a problem for your investment in the future, and obviously if there are any red flags with respect to a questionable background, right, that you can raise those questions with the person if in fact they come up on a search somehow, right? So that's the first thing. The second thing is, particularly when you're dealing with first-time syndicators, it's really, really important to do your homework. And that's because, there are things that you experience when you're a syndicator over time that you gain experience. You know how to see deals, run deals, and things like that, that a first-time operator doesn't have. It doesn't mean you shouldn't invest in a first-time operator, but if you do, you definitely want to make sure that they have a good basis for what they're doing. Whether it's operating partners that they're working with,
Mhm.
people who are backing them, who are credible sort of investors, who would have done some homework to make sure that these operators really can live up to what they say, right? So that's another thing to be pretty sensitive about. Even if it's not the first deal, you also want to make sure that they have experience in the type of investment you're talking about, right? So just because someone operates a self-storage real estate business is very different from someone who does ground up development work on a multifamily property, right?
Sure.
So they shouldn't be lumped together. They're different. They have totally different metrics, ways of how they operate, and so it's just important to understand how much experience they have in the specific product that they're actually trying to get folks to invest in, and so that's important. Another area which it's not like it can't be overcome, but important, if the operators who are syndicating the deal are remote, it's important to make sure that they have that local knowledge. Like, as we say, real estate is all local, right? So you really should make sure that they understand the dynamics of the local market. It's really, really critical, because that intelligence is vital to making sure that a property will be successful, right? And so that's another piece, right? Making sure that the terms that they're offering are realistic. That's important, right? The time frame for how they expect to get the project done. Is it too fast? Is it too slow? Or does it seem about right, in terms of what you would expect for a deal to get done? Are their cost estimates reasonable, right? And this is where education really, really pays off, where you have a good sense as to whether or not they are estimating things properly, in terms of cost, right?
Mhm.
And then another area that you definitely want to make sure to have, and this I do believe is a red flag, is if they're not giving you enough information to clearly understand the deal, right? And we'll talk a little bit about what are the documents that you should see. But if there is a significant work to be done, is that clearly spelled out in writing in terms of the process, right?
Mhm.
How do they expect to get from point A to point B to point C, right? From development or rehab to property management. Can they clearly explain the steps to you in a way that will make sense, and give you a real world picture? Because if that's not spelled out, it could signal that that you may, either they're not exactly sure, or they're potentially they might be hiding something, right? So
Mhm.
it's always good to get that information, when you're doing a deal, to make sure that you have everything you need to understand the process of where they're going. So these aren't necessarily red flags, but they are things that you should, if you spot them, um, ask additional questions,
Mhm.
because they're definitely important to understand before you invest in a deal.
Yep, absolutely, absolutely. All
Mhm.
great points there. All great
Mhm.
points. And are there, kind of documents so yeah, the next question is, so what types of documents should you typically see when reviewing a syndication deal? What do you look for on
Yeah,
those?
Yeah, that's a good question. So most syndication deals are set up with an entity where passive investors invest, right? And typically we either see a limited partnership or a limited liability company where the operators, the general partner or managing member, and the investors are, limited partners or members. And so you need to have an operating agreement, and that's the agreement that actually governs what will happen with the company, all right? And it basically lays out the rights that the management rights that the general partner or managing member has, and it will explain, sort of how they will exercise those rights, as well as it will explain, if there are certain things that a limited partner has veto rights over, potentially, right, depending on the type of deal. But it also lays out the economic rights, and these are vital to understand, right? In a variety of ways, right? One is, in these deals, oftentimes there is a waterfall in terms of distributions where the investors will get paid out based on a set standard in terms of how it happens. Oftentimes you get your capital back, and then there may be a preferred return depending on the deal. And then you as the limited partner and the general partner will split the profits from there, right? And that's where the general partner earns a carried interest, and the limited partner earns a return that's rewards them for their investment. But the details of that distribution waterfall make all the difference in terms of what the return you will get. But it also helps you understand how your interests are aligned with the general partner, right? Because you want to make sure that is there, because it's critical to make sure that the general partner has the same incentives as you do to make the project as successful as possible. In other words, if they're mainly earning fees on that have nothing to do with the performance of the project, their interests may not necessarily be aligned, right?
Yeah.
Another area that I think is important to understand in the operating agreement is what happens if there are cost overruns. And that's always a good question to ask your GP, right? Because if there's an expectation that the project will have a budget. Sometimes the budgets go over. What does the operating agreement or partnership agreement say happens in the event that there's a cost overrun? Are you required to contribute additional capital? Is it voluntary? Typically, unless people contribute equally, it'll typically dilute your interest. But it's important to understand whether you'll have to put additional money in, or if it's a voluntary exercise, because it helps you to set your expectations as to how much you look to allocate to the investment. So that's the operating agreement. The other important document is the offering memorandum or private placement memorandum, which lays out in more detail what the plan is for the property or the particular investment. And that's where you get the detail to understand what's in the operator's mind in terms of how they expect to make money on the project, laying out specifics, potentially with respect to, sort of how much they'll need in financing, if that's necessary in order to do the deal, who their operators are. There should be explanations if they're not operating it entirely on their own, or the property manager or developer, that explains all of those details in terms of who those folks are. But the other thing two things that it does, it's important, is it lays out the specific risks associated with an investment of this type, right? And so it's important. It's oftentimes seen like boilerplate, but it is important to understand the risks, because all investments have risks of some kind, right? So important to see and those risk factors and read them. And frankly, if they're not there, then that is something you should be aware of. The other thing is potentially there might be conflicts of interest, right? In terms of if the operator is utilizing a third party in order to provide certain services that may not be an arm's length transaction. There's nothing wrong with that per se.
Yeah.
It's just important to understand what those relationships are so that you can evaluate your comfort level with that investment. And the last document is a subscription, the subscription documents, and they have, among other things, a questionnaire that will allow the operator to determine whether you're eligible to invest. Typically, because these investments are offered on a private placement basis, at the very least, investors will have to be accredited investors, right? And that's typically someone who has $200,000 in an individual income over the last 2 years, or $300,000 with a spouse and the expectation of achieving the same in the current year, or someone who has $1 million in net worth, excluding the value of a principal residence. There are other accredited investors sort of things, but those are the most important ones typically for investors. And so the sponsor needs to understand whether or not the investors meet the qualification thresholds, and they also have to vet to make sure that they get they understand the identity of the people who are investing. So typically these are the documents you see. Depending on the type of deal, you might see other documents. For instance, if the vehicle invests indirectly in another entity, right, you might need to see that entity's documents, whether it's a joint venture or another underlying investment vehicle. You might see those documents, but those are the three baseline documents that we're basically talking about.
Sure, absolutely. I usually start with a subscription agreement because,
Mm-hmm.
quite frankly, you want to make sure they're qualified before going through everything
Absolutely.
else. Right.
Absolutely. So, yeah. Why waste people's time, right?
Right.
Yeah.
Yes, of course. Time is money. So,
yeah.
Excellent answer. I really enjoyed that. And of course, I want to reach out to the crowd here. I see more people jumping on, which is great to see. If you have questions as we go along, please write them in the Q&A or the chat. Either one will work for us. Q&A is probably best. You can type them right in there. I also put in the chat here our Facebook community. Someone had asked for that, so I put in that information. I'm also going to put in our website, peoplescapitalgroup.com, as well. So as we go along here, you can check out our company. And Richard, also, if you want to put your information in the chat, that might be good as well if you could do that.
Aaron, if you don't mind, if you can put my email address, that might be helpful for me. I appreciate it. But yeah, I'm always open, and you can connect with me on LinkedIn as well. So I'm always around and happy to provide the perspective. This is a very exciting asset class, particularly the one that I believe builds most long-term value, and especially in this day and age when there's a whole lot of volatility in public markets. It's nice to see assets. I'm a strong fan of cash flow assets, and the real estate. On top of that, I mean, it's a tangible asset, which is really great. So.
It's nice, right? You can touch it, you can see it. You know why people are going to want it. It makes sense.
Yeah. Everyone needs housing and storage and all kinds of things, right? That demand doesn't go away. So
Yep. Well, housing is not a luxury; it's a commodity. That's the commodity.
It is absolutely. Yeah. So that's hopefully a helpful perspective on the LP side, right? In terms of viewing how we think about things, and so I'll feel free to chime in with questions now or later, and we will obviously make time to spend later. But I want to give Aaron the opportunity to provide the GP perspective, because I think it's very helpful for you to understand how GPs look at things in order for you to make an evaluation, right, as to whether or not their philosophy, their process, their viewpoint is something that you agree with, and makes a good investment for you. So maybe, Aaron, I'll start with, if you don't mind, asking a question in terms of how do you go about sourcing investment opportunities and evaluating them when you're looking at them for a syndication deal?
Sure. So I'll start with sourcing them. Sourcing has actually kind of changed through the markets. Back in the years, it used to work putting up billboards, doing direct mail, even putting signs on telephone poles that say, "We buy houses." We actually got deals that way a lot as well. But as the market changed, we got deals different ways as well. Sheriff sale auctions were a gold mine for a while, more on the smaller residential space. And we primarily find good deals now in the apartment building space through brokers. So we're usually working with very established commercial real estate brokers, with all the big name brokers there that are moving apartment buildings in New Jersey. We very specifically focus on New Jersey. So we look for value add apartment buildings. We're looking for something very specific. We manage everything in-house here with our in-house management company. And so our first step then is making sure we have good relationships with those brokers, that we're at the top of their buyers list. And they contact us when they are looking to sell a value add apartment building in North Jersey for a great price. And hopefully they don't contact too many of their other buyers. You see, because in commercial real estate, what brokers often do is they ask for a few weeks or a month or so to market the property to their group of local buyers, their group of good buyers, their best buyers, right? They're A-class buyers. And we like to be on the top of that list, and of course, get access to the deals more quickly and before anyone else. So those are called pocket listings. And our goal is to get access to those pocket listings for as many good brokers as possible. And that's our goal, to get good deals right now. As far as vetting a deal, so we'll break into that part of the question. So vetting a deal is, a multi-process step as well. We're looking at first the financials, right? We can't really run out to every single property we look at. Sometimes we'll look at up to 400 opportunities to buy one. And so it's pretty interesting stuff here. Oh, sorry, Richard, I muted you because there was some noise there. Let me unmute you real quick.
No worries.
Oh, sorry, I muted you again. Yeah, actually, there you go.
There we
go. So as I was saying, due diligence. So, first thing we look at is everything we can look at without going out to the property, right? Financials, paperwork. Obviously, the broker's offering you a bunch of information. You're going to review that. We're going to look up comparable sales. We're going to look up, we know the markets we invest in. So one of the things, Richard, you were saying is important about investing in a GP is that he knows his market, right? Or they know their market. So that's one of the reasons we stick to North Jersey. We've been doing this 10 years. Not only do we have the management company in-house here, so we are limited to these areas we want to focus on, but it's really a good thing because we know this market so well. We know like the back of our hand, and the rent control laws, change from city to city, from town to town. And in fact, one of the biggest reasons people don't invest in New Jersey is because there is so much red tape, and it is hard to navigate that. But just, investing here for years, we like certain cities. We know them very well. Newark, Patterson, Plainfield. Now we're getting into Trenton. We've done well in Morristown as well, Jersey City. So you have to know how to navigate the red tape in these cities. And we have learned how to do that. So it's not easy, but if you could do that, then there are ways to really snag good deals. So we know the market well. We look at comps. We look at the construction numbers, of course. That's one of the biggest factors, right? So we'll go out to the property. We'll go through the property with contractors. We'll nail down our construction estimates. And then once the property's under contract, we're going to do a physical inspection of it. We're going to hire an inspection company to come out and create like 100+ page report. It's crazy how much detail it'll put you to sleep. It's a lot of information about every little thing in the property. It's crazy. So it is a lot of information, and that's just the beginning. So then we'll also we're looking at the collections, right? We'll go back 12, 24 months, as much as the seller can give us, right? Sometimes you get nothing, but you ask for as much as you can. What's he collecting on the building, right? And for really mismanaged buildings, you might not get that information. So you got to work that into the price, understand. Maybe you ask the seller to hold a large escrow. That's what we're doing right now. He's holding a $100,000 escrow for the first, indefinitely, essentially, for tenants that are not paying rent. So when we take over the property, any past due rent that's not getting paid at that time can be paid to us out of that escrow. So we're still collecting rent as we're moving tenants into eviction court that aren't paying. And that's a way to still collect that cash flow, even though the tenants aren't paying when you're buying a mismanaged building. When you say to the seller, listen, 30% of the tenants are not paying their rent. We're going to end up in eviction court with the majority of them. I need you to hold we're going to hold $100,000 escrow in my attorney's trust account, and it's going to be released on a monthly basis based on who's not paying rent. So any back due rent owed us is going to be paid on us. Now you're collecting rent that's the tenants aren't necessarily paying while you're working that into eviction court. That is part of repositioning apartment buildings, is moving tenants in and out. but we're getting ahead of ourselves here. So due diligence, basically, you know, we focus then on the leases, we'll review those, collections. We'll focus on additional things we find with the OPA requests. We'll look at the town for open permits. So just off the top of my head, that's what we do. There's even more as well. Green card, we look into township certificates of occupancy. And of course, really dig into those rent control laws, because you got to understand vacancy decontrol, you know, so you'll read those 3 times or so just to really get them, you know.
Yeah, so I wanted you to thanks, Aaron. That's really helpful. But there's a couple of things I think are important to note, and I'll give you the LP perspective. Note how very targeted the approach that Aaron described is, right? They invest in value add apartment buildings. That's their specialty in North Jersey. Again, a specialty. And then the amount of detail that's provided in order to understand how they approach deals and how they look at deals. That's the kind of thing that you want to ideally get from a GP when you ask them questions in terms of what they're looking for. So thanks for sharing that, Aaron.
Thanks, Rich. Absolutely. I appreciate it.
Yeah. Next question for you is, how are you looking? Is it changing your perspective right now and looking at deals in a rising interest rate environment?
Yes, of course. That is our you know, one of the biggest thing we're keeping an eye on right now. And it is, you know, difficult to know what the future holds. No one does, of course. So we are pricing properties right now. We're underwriting an opportunity. We are pricing it at a higher interest rate than our bankers are quoting us right now. Rates actually aren't terrible right now, around the high 4s, which really, you know, it still works for a lot of properties. But we are lowering our offer amounts. We are estimating that inflation actually doesn't keep growing, of course, which is going to tap down our aggressiveness on our offers. We're estimating that interest rates go up. All right, so we're estimating that a couple things happen here, right? Inflation goes down, interest rates go up, cap rates go up. We're assuming all of that happens. The market gets a little weaker. So we're writing that into our numbers right now. And when we're underwriting a building, we have a very extensive spreadsheet. So we can put in those scenarios, and then we can stress test the building. What happens if rates go to 8 to 9 to 10, right? What happens if cap rates go from 6 to 7 or 8, right, to 9, right? So we need to work that into the numbers and see, well, you know, of course, those are unlikely scenarios. We want to be aware of that. We want to be prepared for that. And that's why we buy the value add, right? Because we are buying it at 25, 30%, with rents 25%, 30% below market value. That allows us to renovate units, release them for top dollar, force value into the property. We don't need the market to go up. We don't need rents to go up. We just need everything to kind of keep doing what it's, if it stays still, right? If rents just stop growing today, property values stop growing today, which is unlikely at the rate of inflation, we'd still be okay, because we are in value add properties. So we want to underwrite it as such, going into a weaker market, going into a higher interest rate environment, and then we're going to lower our offer amount, right? Simple as that. Real estate's still a good investment, right? There's still awesome opportunities out there. You have to look for them. The value add opportunities are where it's at, in my opinion. But you know, we're not going to stop buying real estate necessarily, but we are seeing other institutions slow down. We're being very conservative on our offer amounts, but we like it. For the first time in a while, it feels like the buyer's a little bit in the driver's seat in negotiations on these larger $10 million buildings or so. Now, if you're buying a single family home, it may not feel that way just yet, but you know, hold tight, it may in a little bit. But in the commercial space, we're seeing some institutional buyers kind of lay off, which is fine. And we are being more conservative on our offers. And we are obviously aware of the rising interest rate environment. And we'll keep an eye on that, and then make a judgment call for refinances and timing for things like that. You know?
That's great. Yeah, thank you, Aaron. And just to underscore what, you know, sort of goes into a GP, you know, sort of looking at deals. I mean, typically, I'm sure you do this, Aaron. I mean, before you find a deal, you might look at hundreds of deals, right? And so the reality is, it's still a very challenging environment, and patience is so critical these days. You know, when you have to evaluate so many deals just to find the right one, where, you know, if you have to stress test it, that it works out still. And And so I'm sure that's that's a challenge.
Yeah, absolutely. And that's what people don't realize. Really, our job is to find a great deal. And that's what
Mhm.
you're essentially paying a syndicator for. That's why they're
Right.
getting ownership in the property. Also, of course, they're managing it long term. They're executing a project and a plan.
Yeah.
But a big part of what we do is sourcing a great deal. And
Right.
I'd say half of our time and resources is put into doing that, because you do have to underwrite a lot of losers to find a winner.
Mhm.
And especially in the last 4 years or so, it's been extremely competitive. So I welcome a bit of a market slowdown. I welcome a little bit more opportunity out there on the buy side. Obviously we don't want a big long recession, but something that makes it easier to find good deals again would be nice. Obviously we want our values to stay strong, rent
Yeah.
collections to be strong, but if the market slows down a little bit, becomes a bit of a buyer's market, I'm okay with that.
You need a bit of a balance. It's really not healthy where it goes in one direction entirely all the way, right? It just can lead to a serious dislocation. So
Mhm.
it's
Mhm.
good to have a healthy, retrenchment once in a while. So I agree
Mhm.
with that.
Correct. Yeah.
So Aaron, talking about the fact that we touched on the fact that a lot of deals are harder to find because they don't have general solicitation advertising, which is it's an exemption called 506B, as opposed to there's a newer one called 506C, where you can engage in general solicitation and advertising, but you have to do a higher accredited investor verification.
Mhm.
Which one do you guys take advantage of, and why?
Sure. So we actually operate a 506B generally. We are starting a new fund for every opportunity, and that fund is generally a Reg D 506B. So the reason we do that is because you can accept up to 35 non-accredited, sophisticated investors, as the SEC labels them. And from our understanding, you could chirp in here as well. It's someone with experience investing in real estate with the ability to understand the investment opportunity. There's a couple other things we like to do as well, because it's not always a black and white, the definition. We like to make sure you don't need to live on the returns of the investment. We're not taking your entire investment capital. We generally don't want to take more than 50% of your IRA or available investment capital. Obviously, we want to make sure you have savings for living expenses and things like that. And ample income, a job, and again, not living on the returns of the investment. So in addition to understanding the opportunity and having enough experience to understand the opportunity. So that opens up the door to a number of more people that are not yet accredited. Maybe they're close to getting there, they're doing well, they're gainfully employed, they've put together a large amount of capital, but it's not $1 million just yet. And I've met plenty of sophisticated investors that are very, very experienced, sometimes more than an accredited investor, right? So it's really an interesting space there. But here's the challenge, right? I can't put on a billboard, invest in people's capital group, right? I can't necessarily put a deal out. Well, I guess it's kind of gray. I can't put a deal out on a billboard. It's very confusing, but I can't put a deal on a billboard, right? I have to be careful. I can't put an address and the property and returns and things like that, like a 506C can, and they can just kind of cast a wide net and everyone comes in. If you're accredited, great, you can invest. If you're not, there's the door, basically. At a 506B, it's very different. We're like, we there's no wide net we can really cast. It's more like, hey, real estate's a good investment and we're pretty good at operating it. So why don't you connect with us and learn more? And that's really like the most of what I can say. And that's what like a lot of our social media is kind of 30,000 foot, because it has to be. And the good thing I like about this is now I have to have a discovery call with every single person that invests. That's a double-edged sword. It makes me much busier. I'm having many, many phone calls. But the other side of that is I get to have a relationship with everyone who invests with us. And I personally wouldn't invest in someone I'm not able to talk to, like a lot of these big wigs that you can't even talk to. I wouldn't really like that. So people like how they actually get to talk with me. I've done hundreds of real estate transactions, so I'm a good kind of person to talk to about real estate there and just general investment questions. So I really enjoy the discovery call. I enjoy getting to know my investors. I enjoy helping people invest at the sophisticated level, because quite frankly, when someone has $100,000 in their IRA and they're putting $50,000 with you, that's a huge compliment. And that's a huge amount of trust. And I get that. When someone has $1 million in their IRA and they're giving you $50,000, it's also a compliment, but it's not the same compliment. So That's what I love about it. And when I give them back $25,000 in straight profit, and they still own their ownership in the property, and it's 3 years later, and they're really happy with the returns, we've done better than targeted. That makes me really happy too, because they really enjoy that, so it's always nice to do very well for them and help them build their wealth and see them build their wealth. One of my investors just put his kids through private school because of the returns on our buildings. He's invested with us for years now. So that made me feel really good. And that was really cool. So yeah, so we like doing.
That's great. Thanks for sharing. And I agree with you. Real estate, like a lot of other things, is a relationship business, right? So my advice, is build relationships with folks. Generally speaking, you're good operators, you're good people in general who are willing to connect you and willing to help you to educate and to understand, what it is to invest in this asset class. So definitely take advantage of the opportunity. There are lots of great people in this space who are willing to share their time and their feedback with you. So even if you're looking at a deal, definitely one of those things is, well, feel free to share it with other people, see what they think, right? So thank you for sharing that, Aaron. Do you have anything else to say? I didn't know if you had touched on this already, in terms of how you otherwise qualify folks. Is that something that you had already covered, or do you want to say more on that?
Yeah, so let me just finish the process. So first, we schedule the discovery call. We really like when people kind of watch the educational videos on our website or enjoy the blog posts and the podcasts, and just really digest what we're doing and get some of our free information out there so that they understand what we're doing. And then we do the discovery call. I answer all their questions then. I make sure they're qualified as a sophisticated or accredited investor. They do have to fill out a qualification form. Then at that point, that's going to be a more in-depth form asking, all their information as far as just education level, experience level, income, address, things like that, to understand who they are and if make sure they're qualified, sophisticated, or accredited. And then, we'll move on to, granted they are either sophisticated or accredited, we'll move on to reviewing an upcoming offering memorandum at that time. A private placement memorandum as well will follow. And, it'll all kind of start with an executive summary of the opportunity, and then we'll go forward from there. And then we'll have a due diligence package investors can review as well. But yeah, the qualification process is pretty painless. We just schedule about a 15 to 30 minute discovery call. And then we'll often do another call before the person invests as well to answer their final round of questions. I also make a webinar explaining the investment, so that can answer a lot of their questions as well. Once people invest with us a couple of times or one time, it's generally there's less phone calls involved, unless, of course, they would like more phone calls. So it really depends. And I have investors I'll talk to all the time now that have 7 figures with us, and they really just like talking to me, I think. So it's a good time, and absolutely. So that's the process.
Absolutely. Thank you, Aaron. One of the things that you just triggered in my mind that is truly a red flag, and this is actually something that folks should heed, and it probably applies in general when someone's trying to sell you something. If they're pressuring you, or they're not giving you information, they're not being patient in terms of helping you to understand a deal, that is a true red flag in my mind, right? So be careful of situations where you see that, because more than likely there's something not quite right there. So that contrasts with what Aaron's telling you about, the desire to really get to know their folks and to really spend the time to explain those deals. So thanks for sharing that, Aaron. How about, how do you look at, this is a good question. How do you see, what is a passive investment in your mind?
Sure. So I like this question because I remember when I did an internship with College Works Painting, they said to me, it's easy to start a painting company. You just get your friends to do the work, and you put your feet up in a lawn chair and you watch them paint the house. And so I hired my friends. So I got a bunch of painting gigs. I had no idea how to paint houses. This was junior year of college. It was the craziest internship. And it was great. I learned so much. I hired my friends to paint houses. They had no idea what they were doing. So it was the furthest thing from putting my feet up in a lawn chair. I was, constantly picking up messes, learning how to paint houses while painting houses, not really pleasing my customers all that well, and learning that to run a good business, you actually do need to know what you're doing. If to run a painting business, you need to know how to paint. So, the internship, we learned a lot of things in that experience. So I don't know if I suggested it. Was definitely not for the faint of heart, but that was not passive income, right? And also so later on in my life, I bought a 5 unit, and I hired a management company, and they filled the building with TRA tenants. And within 6 months, 4 of my 5 tenants were not paying rent, and I ended up with a nearly empty building. Well, not even empty, it was occupied, but no one was paying. It was getting beat up, and it was a tough situation. So my first couple of years in the building ended up losing money and switching management companies a lot. We hired a management company one time that was stealing money from us, tough experience there. So I realized owning real estate and hiring a management company is not truly passive income. In fact, you got to keep your eyes on the management company. And that's why we developed our own management company, because we just were not getting the performance out of everyone we hired. And we also reposition buildings, so it's a really heavy lift buying a mismanaged building and making it perform. Most management companies really don't want that much heavy management. They're looking more for turnkey opportunities, which are easier to manage. So it's not impossible to own an income property, a 4, 5, 6 unit, maybe a few duplexes, and have a management company manage it, especially maybe some Morristown or something nice area. But at the end of the day, it's not true passive income. And that's why real estate syndications exist. So we can buy large buildings with more units under one roof, which tends to be more profitable and a safer investment in real estate than smaller properties. And you can hire professionals. So we're doing all the work from A to Z, from analyzing the building, vetting hundreds of bad deals to pick a good one, executing construction long-term, management long-term, and then, of course, working out refinancing with the bank and acquisitions with the bank, all those relationships with banks and brokers to sell the property or whatnot. So, it's really a lot of moving pieces, and that's why people hire professionals in real estate. That's why people hire professionals in anything, right? So we don't cut our own hair. So that's exactly why real estate syndications exist. And boy, it's a management intensive business. So if you want passive income, do not buy a multifamily property and hire a management company. It's not real passive income.
Totally agree with that. Totally agree. It is an active endeavor. Having owned multifamily, there's always something to take care of. So yeah, definitely agree with that. So thanks for sharing that, Aaron.
I was
question.
saying the monthly updates too. People learn a lot from those. At the end of the year, tax season, you just get your K1 in the mail. It's kind of or emailed to you. It's really nice. You don't have to deal with all those headaches of tax seasons and bookkeeping and everything. Yeah. So
absolutely. Last question for you is: do you have tips for folks who are looking to get into, investing in these types of deals like you want to share?
Sure. So the first thing you want to figure out is, what are your investment goals, right? With New Jersey real estate, we focus on long-term equity growth. So we look at real estate with a long-term view. If you're trying to invest in 1 year or 2 years and double your money, then we're not the right group for you. We're more of a long-term view of real estate. We get very competitive returns. Our investors just earned the mid-teen cash on cash annualized returns on a refinance. And we don't generally target that. We'll target generally around 11% annualized cash on cash returns, maybe a 15 to 18 internalized annual rate return. But we really tend to do better than targeted, and historically we always have. So you want to focus on, what type of returns you want to make, what type of group do you want to invest in as a long-term, short-term. Do you want to invest in a market high demand like North Jersey, where the cash flow might not be very strong, but the equity growth over time, and which we pay ourselves through the refinance strategy, which has a ton of tax benefits as well. Are you okay with a maturity investment that matures over 3 or 4 years, but then can produce a large lump sum, right? So a lot of real estate investments can be broken essentially into 2 categories. You have more of the maturity investments like North Jersey markets here, where you're buying at a good price, we're repositioning the building, we're refinancing, and then investors are getting about half of their investment back and still owning their full ownership of the property and enjoying quarterly cash flow and continuous refinances. But it takes about 3 years to get there, sometimes 4 years. So it's a maturity investment. Or do you want to invest for cash flow right now, where you might not make as much, but you're going to make it more quickly. Okay, so that's always the goal. Of course, you have equity growth in cash flow properties as well, but then they might be in smaller equity growth areas where there's more cash flow to be earned, but less equity growth. So at the end of the day, there's no right or wrong answer. What I like about apartment buildings is they do produce cash flow and equity growth. What I like about North Jersey, it's a high demand market that if you can navigate the red tape, it tends to hold its demand through slow markets and strong markets. So But listen, you want to probably invest in a little bit of both, maturity investments that are going to mature over time, be large lump sum payouts that have huge tax benefits. You also want to invest in some cash flow real estate, maybe in the Carolinas and things like that, right? So you want to diversify. That's the bottom line. And did that answer your question? What was?
Yeah, no, that was fantastic. Yeah, and just to underscore what Aaron said, those are two great ways of looking at sort of the profile that you want for the type of returns you're looking at, and then obviously different types of investments have different profiles as well. So no, that was great. Well, thank you for sharing it. Yeah.
Absolutely, Richard. No, it's great information here. And yeah, I'm glad I could explain how we help people invest in real estate. And again, if anyone has any questions, feel free to put them in the chat there. But yeah, really enjoyed, Richard, having you on here. I think you're a wealth of information. And I also have your information in the chat as well. So if anyone wants to reach out to Richard there for SEC advice or legal advice in general, although this was not legal advice, as a disclaimer. And it was not a solicitation for funds, tax advice, or legal advice. Isn't that right, Richard?
That is correct, and that's why he said you remember that I didn't. I love it. Yeah, no, but always happy to be a resource. I'm passionate about real estate. I do think that it is an area that that you can really get to learn to embrace and enjoy as an investment, and really see how these projects develop over time. And frankly, it's in a lot of ways, a huge benefit for society too, right? Because you're providing something of value for folks, and making sure that there's something, it's not just in many cases, not just a matter of financial return, but it's more than that. So it's I find the investment pretty meaningful, and I'm sure Aaron and his team do too. So
yeah, and we and to add to that, we really try to put our best foot forward with whomever we're doing business with, whether it's a multi-million-dollar investor or a tenant of ours that in a mismanaged building that we're saying, hey, we understand this is a building with challenges. We're going to fix that leaky dishwasher, tighten up that those cabinets that are falling off, and make sure the building is performing well, clean up the common area, make it smell nice and look nice. And then for tenants that just want to move out, we generally work out amicable cash for keys options that kind of gives them moving costs and things like that covered. And then for tenants that just are not cooperative, we still try to work out payment plans or avoid eviction court whenever we can. And so it's always good to understand, we're taking these buildings that are often kind of sometimes owned like by slumlords before, and we're coming in with our management company and really making it a nice place to live, to raise your family and feel safe and protected there. And, it's one property at a time, one corner at a time, and make our small little difference there in Newark or Patterson, and by treating our tenants with respect. And I always say a happy tenant equals a happy investor. So that's one of our rules of People's Capital. I really want to get that on the wall, actually. That would be great. That's my goal here. I do have a comment here. Here's from Sunny. It says, as a passive investor, we look at metrics such as projected returns, cap rate, ARV, occupancy rates. What are your other top 3 metrics to look at? Excellent. Okay, so that's probably a good question for you, Richard. I'll also add to that. So again, it's we look, as a passive investor, we look at metrics such as projected returns, cap rate, ARV, occupancy rate. What are their top 3 metrics to look at? So maybe I'll let you answer that, Richard.
That's a good question. I mean, occupancy rate is good. I mean, turnover, right, in terms of what you're looking at. Definitely. Let me think of sort of other metrics that we look at. I mean, honestly, those are probably the ones that we primarily focus on. When we're looking at properties. I'm trying to think of what else that we typically would think of. Aaron, maybe you can chime in.
Yeah, let me chime in. So I think historical returns are important. That's how have you done in your past projections. Projecting something is hard, right? Like my job is to sit here now and project something 5, 10, 15 years down the road. So, we're just human beings. We can only work with the data we have to make the most calculated projection we possibly can. And we want to be conservative, but not too conservative, because you'll never buy anything. And, but you also want to say, okay, well, what's likely to happen? So we look at what's going on with the job market in that area. One of the things I like about Trenton, New Jersey right now, one of the reasons we're looking at buying a $10 million building there's a big Amazon warehouse, like 15 minutes from the building, that is just a huge hiring center. We see a lot of other cranes in the air. We see high-end real estate being developed there, and they have no room left. So no one knew if they were going to get $2,250 for luxury 2 bedrooms in Trenton. Well, they are. In fact, they ran out of them. Right. So if we're asking for $1,850 for our luxury 2 bedrooms, well, I'm not really worried about it, because first of all, the building's already getting it, and the guy down the street's getting $2,250. So I'm asking a whole lot less. We look at what are other buildings in the town and city doing? What are they renting for? What do they offer their tenants? What amenities do they have? What big hiring centers are around there, what Fortune 500 companies or just large companies are around there offering quality jobs that your tenants are going to need. You have to kind of know the type of building you're going to have and who's your tenant going to be, right? That's a question I like to know as well. Do they make $60,000 a year? Do they make $95,000 a year? Do they? So we have to understand that, and that depend on the type of building you're in, Class B, Class C. But we're kind of painting a picture. Who's going to be renting our building? Who's going to be working on our building? Where are they going to work? Where are our tenants going to work? Where's our money ultimately going to come from, right? So, and what quality tenant are we going to attract with our type of building, our type of amenities? And that's how we come to those projections. And those are additional metrics. In addition to that, Sonny, those are 3 or very good metrics you put forward there. But I also look at those metrics as well that I just mentioned.
Yeah, that's great, Aaron. And one of the things I would add is, and you can find websites that look at neighborhoods very specifically. We also look at crime rates. We look at sort of education in sort of institutions in the area, particularly if you're catering to families, right?
Yes.
Things that sort of, as Aaron said, really depends on who your target tenants are, because obviously certain things will matter to them. In terms of what they see, potentially, you got kids, or the playgrounds, or there areas that they feel like, they can be safe, and those types of things matter too.
Right. Of course. Good point. Parking, that's always a factor. We really like buildings with parking, because people that own cars tend to be higher quality tenants as well. So, but I know you're a city guy, Richard, so I don't want to make that assumption.
Yeah, New York is an exception, but I can tell you that there's never enough parking in the properties that we have, and it's always in demand for sure.
Yeah, absolutely, not making any more of it. So
no.
land
for sure.
Yeah. All right, excellent. Well, we'll wrap up here then for the evening. I know we have a lot of time here from 7 to 8. So thank you so much, Richard, for joining us. I put your email there in the chat. Yeah. And great. I also put our website there, peoplescapitalgroup.com. So if you do want to learn about getting qualified as a sophisticated or accredited investor, and learn about our upcoming opportunities and how we help people invest in high demand real estate here in North Jersey, then go to our website, check it out, digest our content there. We have videos, blogs, tons of information. And of course, our podcast with Richard, you can check that out as well. And we'll put this video up next week also. And we have tons of webinars coming up also. So sign up for those. You can follow us on social media, but that all happens at peoplescapitalgroup.com. You can get qualified with us there also. And Richard, do you want to do a shameless plug?
Well, yeah, no, just, feel free to connect me by email or LinkedIn. Richard L. Chen, PLLC is the law firm. Feel free to reach out if we could be helpful in any way. But thank you again for having me, Aaron. This was lots of fun. And, definitely, as Aaron said, this is just a great opportunity to share, what Aaron and I have learned over the years. I think I started right around the same time that Aaron did too. And it's amazing to see how things have come since then. So, if we're able to share a little bit of knowledge to help you out, it's a pleasure to do that. So thank you.
Yeah. If only we bought more real estate back then, huh?
Oh my gosh. That's such a huge regret. I know. It's like, what was I thinking?
What was I thinking? Right? Oh
no,
my gosh. Oh geez. All right. Well, all we can do is live and learn, right?
For sure. Yeah.
All right. Thank you, Richard. Have a good night.
Have a good night, everyone. Take care.